All right, good afternoon, everyone. Welcome to the Ask a Financial Professional webinar series. This webinar is offered by Cal State Fullerton Extension International Program in conjunction with our instructor, John Wang. The Extension International Program at Cal State Fullerton offers professional development and workforce relevant training to support the growth of professional talents in the area. We offer programs in cybersecurity, user experience, human resources, to name just a few. And of course, we offer the classes in Designing Your Financial Life, in which our speaker today has been teaching for many years. In addition to teaching at Cal State Fullerton, our speaker owns and operates his own investment firm. So John is a proud alumnus of Cal State Fullerton and is the founder and CEO of his financial planning group located in Placentia, California. He is an enrolled agent and a CFP. He has been in active practice since 2005. Well, John, you don't look that old, and holds numerous licenses, registrations, and certifications. John is very active in Orange County, both professionally and personally. He believes that everyone deserves financial education opportunities, and these opportunities should be objective, unbiased, and come with no strings attached. So we're very lucky to be able to have him talk to us today. We are excited, and we know that we can't wait to jump into the conversation, but a couple housekeeping items I just want to sort of clear up first. First of all, these sessions are being recorded. You're also muted for the duration of the presentation itself. So John will be sharing his analysis for the first 25 minutes, and the remainder of the hour will be available for answer and questions. So this is the most important part. Please post your questions in the Q&A section of this webinar. This will allow us to monitor the questions, and at the end of the presentation, we'll be able to bring these questions forward. We will attempt to address as many of them as we possibly can. John, I know in the last two webinars, we were able to offer big picture overview of the strategies to create, financial health, whether it's getting out of debt or repaying loans, et cetera, et cetera. Looking at the questions that people submit in the feedback that we got, I think let's focus on investment strategies today. What do you think? Because I think that can really begin to take us into a different, sort of a different direction in the discussion. So if you're okay with that, go ahead and take it away.
Awesome. All right. Well, good afternoon, everyone. Let me get my screen up. So let me do the screen share. So just a quick recap. So really the foundation of good finance or good financial planning is in the management stage, right? Which is where you have a good handle and you have good control of your finances. And then to build on top of that is really important to make sure you have good savings. And so saving is learning how to walk before you then can run, which is investing, right? So I can tell you people that are not good savers are terrible investors. And if anybody who makes a lot of money and then they kind of wonder where did it all go, again, because they kind of skip the step of having a good savings plan and being able to allocate and account those money for certain things, right? Instead of just focus on making money. So let's talk about the growth area, and that's investing, right? Is to grow. So simply put, I mean, this is very easy. The what part is the investment, the how is the strategy, right? So a good example is, let's say you want to invest in ETFs or real estate. Okay, so that's the what that you're going to be investing your time and money in, right? And the how is like, well, how are you going to structure that investment? Are you going to use your, believe it or not, I don't know if you know this, you can use your IRA to buy real estate. You can use your IRA to buy anything because there are some things you can't buy, like you can't be buying antiques, life insurance, and I think cattle or something like that. But other than that, you can literally buy anything. You can invest in startup businesses. you can loan money that way. So there's a lot you can do with an IRA. But anyway, so that's a good example, right? So you want to invest in X, let's say Apple stock, right? Because that's simple, or Microsoft stock. So that's the what. And the how is that, are you going to use cash? Are you going to buy it using your IRA account? And the other thing is that how are you going to, buy into it, right? Are you just going to do a lump sum investment, or are you going to dollar cost average, meaning you'll buy, let's say, 100 shares Friday of each week at 12 o'clock, or at the end of, or the beginning of market open, or whatever, right? So whatever your strategy is. And then also you plan on exiting, because part of buying is you got to know when you want to sell, or if you don't, or you just have a really long time horizon where you want to sell it when you're, in your 50s, or, or on your birthday this time next year, or whatever, right? So that's the strategy, right? So to put it simply, and I know there's some questions around that. And here's something that I put together, and I since I've been in practice, and I do this for myself personally. So I put together, and I bring this up in the class, the Designing Your Financial class, your financial life class. And this is a financial decision formula. And so this helps us. The thing with investing is that we got to control our emotions, right? And a good way to do that is having some type of checklist, some type of something that really lays it all out, so we're able to understand it fully. So like, for example, let's use the example of investing in Apple stock, right? So you're going to decide to invest X amount of money, let's say 100,000 or 10,000, like $10,000. And then the timing, you decided to buy it at the beginning of the month, the middle of the month, before they announced their quarterly earnings, right after, I'm sorry, that's timing, but like the time is like, how long do you plan on holding this investment, right? For time horizons, like say 5 years, 15 years, whatever, right? At least a year, so you get long-term capital gains. Again, what's your plan, right? So the timing is, again, when do you plan on entering the trade, or buying your position, or investing, right? So, and then the other thing is, what's your expected rate of return? Are you expecting a 10%, a 2%? What is it, right? Or are you expecting a negative return because you're looking for some losses to offset if you're investing in something that generates losses versus, depends on what your plan is. And then you got to look at the fees, right, and charges. What's the total cost? Because in my industry, we call it different things, but basically how much it's going to cost you, right? We call it ratios, expense ratio, loads, spreads, what other terms are points, right? So you got to just, whoever you work with, just how much is this going to cost me net, right? So, and that will give you a good idea. So like, because a lot of the funds that you invest in, ETFs or whatever, or mutual funds, notoriously, they quote you gross return numbers. They don't quote you net. So like, let's say a mutual fund generated a 5% return last year, they would publish that, but they don't tell you that, well, there was a 1.5% expense ratio. So technically you take 5 minus 1.5 and that's your return. So, look for that. Inflation, right? That's a factor. Taxes, right? Take that into account. And then also risk factors, right? What are the risks? And this is really important. Great investing or a good strategy is one that manages risks. Show me a great investor and I'll show you someone who knows how to manage risks, who knows how to identify risks and can manage it effectively. And that's it. It's really that simple. It's simple to say, but pretty hard to do. But again, it's all about risk management, right? Understanding what those risks are. And then what are the benefits of doing it, right? So is it just so you can be cool with your friends because you have the same stock, or you invest in something, or I'm just kidding, that's generally not a factor, but or something that's really important. But what are the benefits of investing in that, right? Because it offers what? And because it complements something that's a part of your portfolio, your investment plan, your whatever strategy that your overall strategy or plan. So all of that equals to the total benefit of investing or ownership, right? So TBO, we call it, like, what's the total benefit of owning this versus that? So yeah, when you take that into account, it gives you a really good idea of when you make an investment decision, right? So, and I know we've been talking about this a lot because everybody's concerned about retirement because that seems to be the destination, right? It's retirement. And so when it comes to achieving retirement, I want everybody to kind of understand retirement is not an age thing. For some reason, I think it's just because of our history. Social Security when it was started or implemented, people just focusing on an age. It's not. That's like the biggest paradigm shift that people need to make is it's not about age, it's about passive income. And passive income comes from what? Assets. So it's really about building assets. So for example, traditionally when we retire at age 66 now, we get Social Security, maybe a pension enough to, let's say, to cover my lifestyle or to cover my ongoing expenses, $50,000 a year after taxes. And I'm able to achieve that through my Social Security, my 401k, my pension or whatever, then I can be retired, right? Well, you can do that at age 25, 30, 35, 40, it doesn't matter, right? Because let's just say you've been able to accumulate assets, say real estate, you invest in businesses, you invest in great stocks that have grown to, let's say $10 million or $1 million, right? And let's say 10% of $1 million, let's use $1 million as an example, 10% of that's $100,000, right? So you're basically done if you can continue that. So just the idea is that people need to understand, or we need to understand that retirement is, it's not an age thing. It's has nothing to do with age. It has everything to do with assets. And so our challenge throughout our financial life is to accumulate as much asset as possible. What are some examples of assets, right? We're talking about things that pay us, right? So real estate, investment property, not our home, because our home doesn't pay us, except it provides us with shelter and yada, yada, yada. Investment properties, any type of investment, like some type of bond or stock that generates income or grows in value, businesses, et cetera, right? And then, think about, how are those things going to be taxed? So, work with a tax planner, not a tax preparer. That's someone who just prepares your tax. There's no value in that, in my opinion. Find someone who can really help you look ahead, right? That's planning. It's looking forward instead of preparation. That's looking backwards, right? When it comes to taxes. So, and again, all of this will make more sense in the context of your financial plan, right? So, and I think a lot of the, well, not I think, but all the resources that's provided thus far, the 6 resources, it'll show you literally how you can piece together your own financial plan. So, all right, so let's move on. So this is just another example of this 3 stages of asset building, right? You have the beginning, the middle, and the end. So an asset, to kind of lump it up, is like, let's say your 401k or 403b or 457 or TSA. Oh my God, there's so many retirement accounts out there, but basically you have the beginning stage of when you make contributions, right? So inside of that, you buy ETFs, you buy mutual funds, you buy your company stock, whatever. And then you let it accumulate. And at the end of it all, that's your distribution phase, right? That's when you're retired. That's when you're no longer working, but now your money is now working for you. Or actually it's been working for you, but now you get to see the fruits of your labor, right? Now it really bears fruit. So again, retirement is all about assets. So that's why I put that, let's see if you can see my little arrow here, right? Retirement, assets, that's it. So don't simply retire from something, have something retire to, and begin with the end in mind, right? That's it. I have plenty of clients that, I at first, before I got started in the industry, I always thought that you have to have a lot of money. No, you don't. You just have to have a good sense of where to position your money, because you can be making $50,000 a year, but because you're able to save and live within your means, you're able to have a lot more money invested towards something, right? And then there you go, and that compounds over time. Because I have plenty of personal, well, like my family members as well too, and friends and clients, where you think, when you make a lot of money, let's say $150,000 a year, that would solve all your problems. But no, it doesn't. Matter of fact, most people's cash flow is generally an in and out model, right? Like, by the way, that's a good name for burger place. I don't know if that's taken yet, but anyway, so I'm just kidding. But like, yeah, their motto is money comes in and then money comes out. So it's really sad. Where it should be money comes in, they're able to save it, invest it, whatever, and then what's left, then they money comes out. But they don't have an in and out model. Yeah, anyway, so something to think about. Let's move on. All right, so questions and discussions, because of, I know there's some of you that submitted your questions early, so you guys have priority. So I'm gonna go through them actually right now. Let me pull up my question sheet. And so, and if there's more questions, feel free to put them onto the chatter, so the moderators can get those organized and then add to the questions that that's given to me. So there's,
yeah, John, and
yeah,
as you're going through the questions, I will also, there are some really great questions that are being posted. So
okay.
I'll probably add to what you're,
okay, good. And then,
to.
yeah, and then I'll clarify. So good. So the first one's, how do I invest in the stock market? You just go to your local stock market and start buying stuff. No, I'm just kidding. Well, there's many options, just like credit cards, right? There's many avenues to be able to buy stocks. There's apps that you can download. I don't want to be endorsing any one of them, but there are plenty. And by the way, you can Google that and they'll tell you. So there's many options, but yeah. So, but just make sure that your mindset is correct, that you're not there to just speculate and move things around, but you're really, because you like a company and you want to buy into that company, right? And then, yeah, again, your banks can do it, anybody can do it, but just know that basically with the advent of no fees, there's basically no commission. If anything, they charge you they charge you like an exchange fee, if any, and it's like 25 cents or something. It's nothing. So, but yeah, so that's an easy question. So there you go. Oh yeah, my recommendation is go with one with a lot of research tools and a big company, so you can take advantage of their resources and research. So and customer service. All right, so next one is, should I save or should I try to pay off my loans due to COVID-19? So should I save or try to should I save now or try to save? Okay, so because of COVID, right? So by the way, because of COVID-19 and the health crisis, or the health, yeah, I guess you can call it the health crisis that we're in, it allows for us to not have to make payments on, I think, credit card bills, any type of bills, like to be able to basically defer all of those payments. Forbearance, you probably heard that word, right? So just so we're clear, the interest that you owe on the balance of your debt is still accruing interest. Got it? So don't think that, oh, hey, they allowed me 4 months of, I don't have to make a payment. Well, those interests are being added on. So if you're able to pay it, right? If you're not, because of whatever, just know that those interests is still being accrued. So if you're saving, then obviously, you're adding to your savings. And if your savings account is paying you, let's say, 1%, I don't think that exists, but anyways, let's say 1%, then you're getting 1%, but just know that the debt balance that you have of $10,000, for example, it's still earning interest there. They're just, they're not going to ding your credit or anything like that. But again, you're still, interest is still racking up against you. So there you go. So I don't know what your plan is, but, do the math and, make your own decision there. How should students start paying off their student loans? How should students start paying off their student loans? Well, for me, I mean, I don't know what that student plan is and if they're able to, but the idea is as early as possible, right? So, I guess I work with a lot of clients where when they graduate from college, they have 6-figure loans. But yeah, so the goal there is, instead of investing, they should be, I would help them put together a plan to pay off that student loan as fast as possible, as much as possible. Why? Because they're in a career or a job or whatever you call it that pays them more than $80,000 a year of modified adjusted gross income. So if they're modified if their adjusted gross income is above $80,000. And by the way, when you rack up that amount of debt, you should be in a job that pays you more than $80,000. If you're not, then terrible investment. Anyways, but yeah, so let's say you're now making $100,000 plus a year. Well, you cannot deduct the interest on your loans. So that's what we call bad debt, right? So if you have debt that you're able to deduct the interest, then it's okay to, to still keep it. But obviously it's really not, because it's still eating you alive, right? Yes, you get a tax deduction, but you're still losing money. So you want to pay it off as soon as possible. So that is by far the first priority. In my opinion, generally speaking, the smarter thing to do is pay down your debt before investing, right? Unless you can show me a guaranteed investment that is no risk, guarantees you, 10% rate of return compounding, and you can take it out anytime. And yeah, the perfect investment. If it is, do that, but it doesn't exist. If somebody tells you that, either they're not licensed, they're speaking out of compliance, and yeah, you should run. So it doesn't exist. Anyways, if it is, I would put all my money into it, and it's pretty easy. So, investing is pretty easy then. Do you recommend having no credit cards? Do you recommend having no credit cards? That's interesting. Yeah, a credit card is a tool, right? It's so to put it into a category where it's an evil thing, it isn't. It's just, it is what it is, right? It's how you use it, right? It's like a knife, right? It can cut you both ways, or whatever that saying goes. Yeah, so the credit card. So it's, I don't recommend it if you really have poor saving habits and poor spending habits, to be more exact. So I see a credit card as, you should not be getting a credit card if you cannot use it to pay for something and you cannot pay within 30 days. If you can't do that, do not get a credit card. But if you can, oh my God, your credit card will work for you. So my credit card works for me. I get 2% cash back on everything I spend. So go figure. So I don't pay, matter of fact, it's a benefit for me for a couple of reasons. It's safe. So if anybody wants to rob me, I'll give them my wallet gladly, and tell them to go spend as much as they want. So, because I'm not liable for it. And oh, I guess I can't get those points for their spending because anyway, yeah, but it's fraudulent and I'm not liable for anything. So zero liability, and it's safe. There's tons of benefits to it. And again, I get 2% cash back on anything I spend, right? So, and again, I only spend on things that are appropriate, that I need. I don't just charge it for the sake of charging it to my credit card, right? So it's amazing that this simple education, or it's not talked about in school, but there you go. All right, how many savings accounts should we have? And in parentheses, they say like rainy day, emergencies, etc. How many savings accounts should you have? Well, yeah, you should have as many as you feel comfortable and that you can account for them, right? So, and when we're saving for something, right? So if we know that we have risks of medical bills and things like that, then make sure you have enough for the deductible, right? So anything beyond that, then you kind of add to that, right? Well, what about if my car breaks down? That could be another $5,000. So let's say my medical deductible is $5,000, my car breaks down, another $5,000, so that's $10,000, and that's basically it. I don't have anything else I need to concern myself with. Then voila, then you should at least need $10,000 in savings, right? But then again, like sometimes you can just use your credit card as an emergency, right? So I did that, growing up and maturing, being an adult, is that, yeah, I use my credit card as that emergency, as part of my emergency savings too. So there you go. But yeah, so just make sure you put some money away, and that's important because things do happen. And by the way, those are risks, right? So those are life risks. So make sure, the biggest one most likely is what? Automobile accident. So make sure you have the best car insurance possible. That's really, really important. The other thing is health insurance, right? The number one cause of bankruptcy is medical bills. So make sure you have a good health insurance plan, and voila, right? Don't be, what's the saying goes, penny wise, pound foolish, right? Because these are, the they're fairly inexpensive, but health insurance depends on who you are. It could be expensive, but either way, it can be it can be a lot more expensive if you don't have it, right? So make sure you have those things to cover you. So and I recommend an umbrella policy as well too, right? So on top of your home auto, you have an umbrella policy to protect you anything above that. It's worth the investment. All right, so the next one, how does one assess risk tolerance? Okay, so yeah, okay, so this is like, so risk tolerance, it's kind of a deceiving word because, and a lot of it depends on, it comes up because you're investing in something very specific. So they say your risk for this is this. Well, you got to think critically, and beyond that, you have to think about your risk profile in general, right? So your risk profile looks something like, let's see if I can show a good example, right? So your risk profile is a lot more complete picture. So, so instead of just saying like, well, yeah, I can possibly lose money in this investment, I'll be fine. Or this investment, if I lose half, you want to see about, well, I'm going to be moving soon. Look at all of your circumstances, right? Your time horizon, the debt obligations you have, the other opportunities that you have, the upcoming life events, whatever. Take all that into consideration when you assess something and its risk. Don't just think of it as, well, this is a low risk investment because it's a CD. Well, that's just a CD investment itself. But how does your risk profile, how does that fit into your risk profile, right? That's what I mean. So don't think that somebody tells you, oh, this is a low risk investment, because even though it's a low risk investment, it can be a high risk investment for you because it will tie up your money because your risk profile is different, right? Or in a sense that you miss on opportunity, you have opportunity costs of, you can take the money, do something else with it, or whatever, right? So just kind of don't look at the investment product or whatever investment that you're doing, just that level of risk, but take into account your overall risk, right? So, and what your objectives are, et cetera. So really important. Okay, so let me get back to that slide. And then, okay, so next question is, and again, there's, by the way, any investment that you invest in, there are risks. If somebody tells you there's no risk, there is. Like, they're not understanding it. Yeah, and you got to see that particular investment that you're making. How does that fit in the context of your, in the context of your financial plan? So really, really important. Don't just do things, in isolation or just by itself, because it affects other areas of your finances, like taxes as well too. How's that going to, affect your taxes? All right, should I continue to contribute towards my 401k with COVID going on and market crash looming? Should I continue to contribute towards my 401k with COVID going on and market crash looming? God, I love this question. Heck yeah. You should be continuing to invest in the market. By the way,
we were just talking about this, didn't we?
Yeah. So if you're afraid of investing when the market is down, you're not an investor. Seriously, in my opinion, because you're not understanding like relative risk, right? Because the best opportunity, the best investment opportunities come about when things are bad, right? When things are good, believe it or not, everything's just overvalued, right? I was lucky to buy my house in 2011, right? I can easily buy today, but I can tell you it's not a good deal. But back then, it looks really bad. So it's really weird, but the times when you're most uncomfortable is the time that you should be, investing, and the time where things are great is when you shouldn't be. Just like when it was an all-time high, yeah, that's when you should put everything into the market. No. So I have a quick illustration to kind of show that point. Let's see if I have that slide, actually. Did I put it in here? Let's see. Oh, nope, it's not in here. So what did I do with that slide? Let me see here. So yeah, but that's, as I load that up, yeah, so you should be. And especially now when things are discounted, you should be making investments and taking advantage of shares being discounted. So yes, buy more into it. Okay, here's the slide. So all right, there it is. So this goes into just the science of behavioral finance, right? And to me, I love it because it has to do with psychology and how we're wired. So look at this curve here. So most of the time when people invest is when there's optimism, excitement, is when your neighbor's neighbor is all talking about it. They open up an investment account for their pets or whatever, and everybody's doing it, and it seems like you're being left behind, right? So so if you're investing during that stage, this is your relative upside, right? Your upside, your growth potential. And this is your relative risk. So believe it or not, people have more risk because because markets, we do know it cycles and it corrects, right? So there you go. But when you're investing in the, down here, your relative risk is what? Technically lower, and you have a lot of potential to go up, right? So for example, so I did this. I bought companies that were heavily discounted, like Amazon. I also bought Zoom. I just recently bought Work, WORK, when after earnings it went down, so I load up on shares quite significantly because I know that my relative risk is low and I know the fundamentals of the company, right? And so I have a better chance of making money. So instead of, for example, like just when banking stocks were being beat up, and they're still kind of beat up right now, and so is airlines, right? You think those are going to go away anytime soon, right? So there you go. So you have a higher probability, you have a higher relative, you have lower relative risk than you think. So it's not going to go down to zero, especially when our Fed chair goes, don't worry about it. We'll buy your bonds and we'll continue to print as much money as the economy needs. Yeehaw. I mean, you can't get any better than that. So hopefully that answers that question.
That actually does. And
yeah,
John,
so
I will say that there are actually a lot of 401k related questions.
Oh yeah, so like where
asking.
people, thinking that one, your employer is still matching your money, right? So you should be taking advantage of what your employer is giving you, and of course, dollar cost average in, right? So having an index fund is great. So I think everybody should at least have some type of index fund in their portfolio because it gives you a broader diversification of the market and you're buying into the largest companies, right? So the S&P 500, the Dow, and the NASDAQ, right? So stick with those. And if you want to invest in kind of emerging companies, the Russell 2000 is a great index to be in. And then there's all of these sector funds too, like banking. So instead of buying like BFA, Wells Fargo, and Citi, and whatever banks that's out there, you can just buy the banking sector ETF, right? And you're good to go. So, so you had some diversification there. So, it's one of those things where a little research will make you a lot of money. And so, during this time, again, people should be learning to invest. However, they are doing that, but I think they're doing it in a very irresponsible manner where you've heard about people taking their stimulus check and throwing it into the market like they're gambling. And because again, the casinos were closed, and so people are itching to make crazy bets, and so they were making these crazy bets, and some of them have panned out, and some of them haven't. And by the way, one of the best things that a mentor told me is the worst thing that can happen to a starting off investor is success, because what happened is that when you just started and you realize, oh, it's so easy, guess what? You keep being reckless, and because you were lucky. And that may be something that can then really hurt the person down the line, right? So, as the saying goes, the only two values that matter is the beginning and the ending value, right? What happens in between is great. It's like you go to Vegas, you have 5 hours to play. So you start with $10,000. That's if, by the way, I don't gamble at all. So, but like, let's say I have $10,000 to play for 5 hours, and then I'm going to hit the buffet and go home. So in that 5 hour, I was able to, my chips stack was up to 100,000. But at the end of it all, I was left with $2,000 worth. So when I go to the cashier, I've lost $3,000. Along the way, it doesn't matter, right? So it's the beginning and ending value. So that's it. The middle in between makes for a great story. So
so
anyway.
John, one of our participants actually asked this question related to 401k.
Yes.
From the opposite of being, risk, or focused on the risky behavior. What about being purposeful? Should we be thinking about increasing your 401k investment by at least 1% each year? Sort of that incremental increase.
Yeah. So again, there's different rules of thumb. I'm the as much as you can invest in the market, especially when you have a long time horizon. That means more than 10 years. Then yes, you have a highly likely chance that you're going to end up doing really well, right? So, but it can be the case where you're unlucky and the year that you retired, the market did something like this, where the joke is your 401k became a 201k. That's really bad, right? So that's why we tell our clients as they near retirement, let's say you got another 5 years left or so, or 3 or 2 years left, then we position your account into safer investments, right? Kind of slow down, ease off on the gas pedal. But when you're younger, keep going. I had a client of mine that asked me, just this is when this whole COVID thing came about and the market was starting to really taper or falling apart. And I think she didn't like the answer I was giving her, but I said, you should be investing more, because I guess she was expecting me to say, stop, contributing to her 403B account. And I said, no, continue to add, because I said, are you going to retire any day soon? She's like, no. Like, what's your time horizon? She's like, well, at least another maybe 7 years or so. And I said, yeah, you'll be fine. Keep investing. And I said, well, what are you investing in right now that makes you nervous? If you're investing in an index and big companies, you'll be fine, right? And again, the Fed, by the way, if they're going to help companies, they generally help the big companies. And the big companies have a lot of leverage and they have a lot of economy of scale. So they borrow money for cheaper and yada, yada, yada. So they'll be fine, especially in sectors that everybody needs, right? So yeah,
Yep.
there we go. So it's the more you can put in, the better. And
Yep.
and then as you near retirement, definitely look at some type of position where you have some hedge or some protection.
Mm-hmm. Well, on the topic of 401k, some of us are actually in a position where we have 403b as opposed to 401k, or have both. So the question is, does person have noticed that their 403b investment options are not as sound as their 401k options? So the rate of return is not as high, or expenses are higher, et cetera, et cetera. So should she be considering putting more money into 401k versus 403b, or split between the two?
Yeah, so so there's a lot of things there to consider, right? So let's say that person wants to max out both, then you're kind of stuck with that. But let's say the person only has like 10,000 to allocate between the twos, then just shift it from one to another. Are exactly the same. The difference is that how it's put together, right? So for example, this fund is put together with, or this retirement account is put together where you only have these, selected amount of investment options versus this one. So, but the tax implication, it's all the same. Because when you retire, you roll it into an IRA anyway, so they're both the same. But so look at the ones where you have the better investment options that you like, that you've done your research and that it's good, then go with that one. And then the ones that, if it doesn't offer you, the one that doesn't offer you the options that you want, then, and you have the money to put inside of it, then ask them for, you can work with an investment advisor, and then what they can do is they can open up what's called a brokerage window inside of your account, of your 403, 457, doesn't matter. That if your plan allows it. Last time I checked, pretty much like all of them do now. Then so they can open up what's called a brokerage window. And so instead of investing in the funds that you have, you can invest in this brokerage window that allows for you to, through this window, you can invest in basically like anything. So, but they'll charge you a fee for it, right? But it's worth it. By the way, I don't have an issue with fees or costs. I really don't. I do. I have a problem with. But if you have something that's good and there's a fee to it and it produced good results, heck, go for it because it's justified, right? There's a saying that goes like, in the absence of value, you know, then it matters whatever cost you're paying, right? That's why a person drives this type of car brand versus this car brand, or this type of merchandise as opposed to this merchandise, is because it's not the brand name, but because of quality, right? Just make sure you're paying for something of quality and of good value. That's, yeah. So I just want to be clear. I'm not against, and by the way, I've seen the other reverse where people promote these no fees, no costing, and they absolutely suck. Like some of these annuities where they're like, oh, there's no cost, no fees, but they suck. I mean, it sounds great where you're like, oh, you can't lose money, but it does nothing. The market like last year went up like 29%, and their no fee, no cost annuity went up 4%. So you tell me there, right? Oh, it was great. It was sold. Your money was protected. Blah blah blah. That's, by the way, that's the market going up. But had it went down, you would have got zero, right? But you know, but the market doesn't go down by that much, and it depends on your level of understanding or sophistication and how you design your structure your your retirement account, right? So yeah, just be very wary because the insurance sales professionals out there calling themselves financial consultants professionals are promoting these products, right? And or these things that sound really good, but again, you know, be critical about it, really do your homework.
Would that be relevant to, there's a question about, you know, IUL versus 401k. Now, I don't know what IUL is, but.
Oh yeah, that's an index universal life. Yeah, okay.
Okay.
By the way.
Is that the same thing that you're talking about?
No, it isn't.
Okay.
Okay, one is a life insurance policy, right, with cash value. And the other thing is a 401k. They're completely different things. One is not better than the other. They like to make it, by the way, they're marketing you something and they're selling you something. So that's why they make these comparisons. You're talking about an apple and an orange. They're completely different mechanisms, right? So if you're going to use a index universal life policy, or a whole life policy as an investment, as a retirement investment, you better know what the heck you're doing. I do this our firm, we do advanced life insurance design, right? Like for the purpose of investments. And I can tell you, your regular average consumer that's putting in as even $1,000 a month, it doesn't work. It's not efficient because there's so much cost inside of an IUL or a whole life or any type of life insurance. Where do you think they get the commission, right? Why do you think they're so motivated to promote that? So I would be extremely cautious. And that person, again, they're showing you something and they're only showing you what's called assumptions, right? Assuming that it does this every year, compounding statically, you know, like 7, I've seen it as high as like 7.5. Well, before it was like 12%, but they're showing you an illustration that your cash value, you know, would grow like 6 or 7% annual compounding. It just never happens. It doesn't. That's so hypothetical, it's ridiculous. And the fine print says that too. That's assuming that they don't do anything funny with the cost of insurance. They don't do anything funny with the caps that they provide for you, because they can say, hey, this year we have a cap of 13, and then next year they change it to like 4. They can do that. If you read the fine print, they can make a cap of 1% if they want to. So, you know, but when they sell you the product or when they present it, they make it sound as if like that doesn't change, you know, and there's so many factors, right? But yeah, it's a very profitable product to sell. Let's just put it that way. I would say 9 out of 10, probably more than that I review are just terrible. They were sold as an investment. And by the way, you're talking to an insurance person. What do they know about investment anyways? If they are, they should be registered properly and really, and by the way, on that subject of a life insurance policy with cash value, ask them, and same thing with annuity, ask them for the internal rate of return report. If they don't know what that is, run. An internal rate of return report will show you based on assumptions of, let's say they're saying it grows 7% every year. It doesn't. Ask them to run it at 4 and if you're really 4 and 5%, and see how that, how the internal rate of return comes out, because the internal rate of return will tell you what's the net cost after everything and what's your rate of return, right, on your money. And that's still assuming that they don't change, some of these costs and fees, right? So, but if they change it, let's say 10 years later, well, you can throw that out of the, out of the, that whatever that they gave you is completely off. So be very cautious. Those are, and I hate some of these people use this term like, oh, it's a Section 7702 plan. It sounds so great, right? Have you heard of a Section 7? Oh my God, it's an insurance. It's cash value life insurance. Okay, what's that one saying goes? A pig is a pig, however you dress it up. You can put lipstick on it. You can whatever, call it different. It's still a pig. So my God. So that's like going back to, that's why it's so challenging for the public, is that when they talk to a realtor, they'll tell you they'll solve all of your financial problems with buying more homes, right? Or investment property. You talk to an insurance agent, and trust me, everything is great with insurance, right? So life, they'll solve all your problems with insurance. You go to a stockbroker and it's like, oh my God, look, the stock market is great, right? Look, they'll cite you stories of people making tons of money in the stock market, yada, yada, yada. You get my point. So it's frustrating, I know. And that's why it's really important to go back to the basics, have a plan, and then be critical about it, and do your homework. Oh, and by the way, that's a good, let me bring up this slide that I put together, because you brought up something. So like verifying professionals, this is really important. So that life insurance agent that promoted that, look up that person under the insurance, that's, their license. Look at the companies they currently represent, see if there's any complaints, see if they have any regulatory issues. Really, really important. It gives you some context, right? The other thing is, if they're registered as an investment advisor or a registered representative, basically they can talk about investment products and investments. Then look them up under FINRA broker check, right? Or investor.gov, type in their name, right? And voila, and check their licenses. It's really important to do that, right? It's that old saying, now as a parent, I understand this even more. You tell your kids to choose their friends, right? Don't let them choose you. Same thing. Choose your financial professional. Don't let them choose you. If they're targeting you, yeah, and you're the lucky chosen one by them, then run. So there's a lot of great options out there. Do your homework. Take your time. Don't rush. And again, going back to behavior and emotions. It's an inverse relationship. It goes high emotions, low intelligence, right? So you don't want to be making, long-term decisions based on, your emotion, either really happy, euphoric and happy, or really, really sad. Not a good time to make important financial decisions or commit your money or your time towards something. So just cautious of that. So
not for a birthday present or anything like that, right?
yeah. So
we have a huge list of questions, and
oh wow, so they built up. Okay.
So let's switch gear a little bit, because you actually talked about this earlier in your conversation. You made a list of, you mentioned a few investment options and things to consider, portfolios to consider, or types of fund to consider when you're investing. So the question we have is, what do you think is the best retirement plan, and what do you think is the best investment plan?
So the best retirement plan is the one that you start as early as possible. So that's planning, right? So you want to start as early as possible, and you want to stay as disciplined and as focused on that plan as much as possible, and don't deviate from it, right? So that means that you gotta, that you've done the math and you want to work till you're 65, because that's the age target that you give yourself. And that means you got to be putting away at least $10,000 a year, or I don't know, $5,000 a year. So make sure you do that and you don't deviate from that, or if anything, you add to it, right? So stick to the plan. So your question is, what investment, right? Or what was that again? Yeah. So what investment is, again, in my personal, I can talk about my portfolio, right? So I have real estate. I have commercial real estate as well as residential, as well as partnerships that invest in real estate that I'm a fractional owner of. So I like real estate because real estate is consistent. Well, it depends on the real estate too. Right now, office space is terrible. And then you can probably guess, oh, gee, retail is terrible. But like, but real estate that are doing well are the following. Like you can invest in like cell tower, phenomenal. There's no COVID issues with cell tower, billboards or whatever. Single family homes, mobile home parks, apartments are doing really well, right? So those are good, investments. So I have investments there. I have investments that are doing terrible too. Like I have a parking lot fund that I invest in. People are not parking their cars, so I'm not making money. I invested in a hotel fund. Oh God, that's doing terribly. And I invest in a anchor grocery store fund that's doing terribly. And then also in a retail shopping center, and that's doing terribly. But anyways, but real estate is great because we still have income, right? So, and it's tax advantageous. So real estate's a great asset class. Another one is buy growth companies, right? Especially for long term, you look at every day, what do you use every day, right? That's the best investment advice that's still true today. So if you're a Coke drinker, buy into Coke, right? And by the way, it's not just Coke, they own a boatload of other brands of drinks, right? You find yourself shopping on Amazon every day. You might want to probably invest in them, right? Like Netflix. I've traded in and out of Netflix more times than that's why I can easily afford that highest subscription. So same thing to like Walmart, right? Like companies that are not going to go anywhere. So those are the companies that I invest in, right? In and out of, and sometimes I stay for a while. But yeah, so don't do the exotic companies, right? Hey, there's this new thing that's going to do something, but it's untested, it's whatever. Those are one of those, you're swinging for the fences, you may get lucky, but just know coming in. It's exciting to talk about, I know, and but those are just, those are hit big, miss big. By the way, when I first started investing, those are the companies I was going with. I started with penny stocks and things like that. No. When you're young, you think you're the law of gravity doesn't apply to you. You think you're the chosen one. You think that you're the exception to the exception, not just the exception. No, you're the exception to the exception. That for some reason you're better than certain people, just the average, right? So, but those are what we call pay your dues, right? So when you pay enough tuition, you wisen up and then you change your strategy and you invest differently. But yeah, keep it simple. Again, look at the companies that you use every day, and your friends are using every day. That's a great start to ease in and invest, right? And by the way, all of those are on sale. So it's sad that people are not investing in them when they were on sale. And now they're kind of back up almost to, and some have far exceeded the price that it was before. So by the way, the good news is it will happen again. So the market will go down again. And the question is, are you ready? Did you prepare yourself, right? Like back in 2000, I shared this before, back in 07, 08, 09, I didn't have as much financial resources that I have today, right? Nor the discipline, nor the knowledge, nor the resources to do research and verify and that I have today. So I'm very grateful. And this crisis I've benefited from it. So in the market, but there are things that I invest in are not doing well. So this is offsetting for that. But that's what it is. When you invest, you have to understand you will lose money. And it may be at the worst time when you don't need to lose money, and you're making money when the time you don't need to pull from it. That's just what it is, right? So just understand that there's no silver bullet, there's no perfect investment. The market will do what it does. There's one thing I learned when you're investing, there's no certainty, there's just probability, right? You know that chances are that this will do well, right? That's it. You've done your homework, you've done your risk assessment, and that's it. There's nothing that's 100% proof. There is not. Or it wouldn't be called an investment. Like a CD is not an investment. A CD is can't decide, right? Certificate of deposit. That's what it is. It's not a, they don't call it, an investment. But
well, what's your opinion on international mutual funds then?
So
what's a smart time to invest in it?
Yeah. So international. how do I say this? Like, so basically they're funds, ETFs and mutual funds that invest in the emerging markets. That's what it is. Like, that invest in international companies. They're great because I think those are beaten up as well too. And there's great opportunities there in that sector. But again, choose carefully and buy big companies, right? So, because right now I think there's still a lot of rooms to run. Like there are a lot of these beaten up real estate investment trusts, the financial sector, the ones that are, when you look at the heat map and, the different sectors not doing well, that's where you should, believe it or not, that's where the opportunity is for some great upside, right? And for those categories, pick the best companies in that category. You'll be fine. So if you have the time horizon, chances are, I'm not saying with certainty, I'm saying probability that it's going to go back up, right? And so, yeah, because we're going to get back to, life is going to resume again. So, and by the way, there'll be another crisis. I can guarantee you that. That I can guarantee you. That will happen. So, yeah.
Well, John, those are really, really great, very informative notes. We have about 4 minutes left. And I know, I'm thinking this question actually closes up the conversation really well, because I know you have a slide for this or have resources that people can tap into. The question is, specifically, how do you recommend utilizing a financial consultant?
Yeah. I think I addressed this last time as well too. Mm-hmm. You should. I mean, like, they're professionals, and sometimes we're our own worst enemy, right? And really, our own worst enemy is between our two ears, right? We talk ourselves out of so many things, and it's just unhealthy. I mean, like me, myself, and I have a great meeting, but like I'm a legend in my own mind, right? It's really hard. But when you're able to have someone to share your thoughts, articulate, that's why we call it counseling, right? It is to when you get counsel, you get clarity, right? That's part of financial planning, is you got to seek counsel, and what that means is that person, you're seeking clarity of your own thinking, instead of getting somebody else's thinking or what they think they should do if they were you, right? They're not you, and it's to clarify your own thinking. So it's really important to have a professional for you to work with. So I tell my clients, like I had a client that I spoke with yesterday, I said, look, my job is very simple, is to help you make informed decisions, not to make decisions for you. You're the CEO of your own life, your own company. He owns a very large architect firm. And so, yeah, you're the CEO, you make the decision. My goal is to just digest information, help make sense of it for you, and present it to you in a manner where you can make an informed decision. So that's what a real professional does. A professional is not, unless they're a salesperson, right? So coming in, you already know you're going to end up with an insurance product, an EIUL, whatever the heck they call themselves, or a 7 whatever plan, and whatever they window dress it as, right? So just be very careful that a professional is there to really help you make an informed decision. And
that website you have on there is the place that you recommend that we go
at least
to,
look
right?
at their license. The CFP board. You can just letsmakeaplan.org. That's the CFP board. So you can look at certified financial professionals that are out there. And whoever you talk to, see if it's possible to get references, right? And learn about how they manage their finances. I mean, it's a conversation. I have this conversation all the time with my clients. I'm very open with my successes and my failures personally. And how am I managing my finances? And so there's no perfect, I wish I can show you someone they have perfect investments all the way around, right? No, there's winners, there's losers, but how do you, but what's your overall plan, right? It's all about best effort. And risk management, right? So, but yeah, in my class, I have a sheet of questions that you should ask a financial professional. Actually, I guess I can send it to you guys and you can send it out. So,
we can definitely
so
do
people
that.
can, if they're engaging a financial professional, here are some questions that they should ask, right? And how should they, I also have, how should they prepare themselves for a meeting as well too? So I went that far because in our class, I keep getting that question over and over again. But again, it's really important to have someone you work with that you're comfortable with, that shares your values, that, you know, again, ask them, what are they doing with their finances, right? How are they managing this time? What are they doing? What's worked for them? What hasn't worked for them? That's different. I can tell you, you can smell a salesperson pretty quickly because they can't have that normal conversation. I can tell you that much. So yeah, and they're all theory based, and there's no practical example that they can give. But yeah.
Wow. Thank you, John. I really appreciate all that information that, you know, from the investment strategy to ideas of how to look at your portfolio. And I hope you guys really got something great out of this conversation. Thank you all so much for your participation this afternoon. As we navigate this really uncertain time, you know, our intention from Extension International Program is to provide our community with access and resources. And so a lot of these information that John talked about today, we will be sending out to you guys via email, so you will be able to access those websites when you need to. This webinar is a series of webinars that we present to facilitate conversation around financial, economic, as well as investment topics that would allow us to provide support to our community. Other sessions within the series are separate from the topic, but together we hope that we can help you to give you some information to navigate this extraordinary time. There is a webinar coming up next week as well, so please join us. We look forward to seeing you all again in the subsequent webinars, and let us know if you have any questions. Thank you, and have a wonderful rest of the afternoon. Thank you, John.
Pleasure. Take care, everyone.